All right, welcome everyone. Welcome to another session of the Emerging Dentist Network. Rob Montgomery and co-host it with my colleagues Chris Wagner and Jake Matlin. And excited to have our first guest ever on the program tonight. Domenick Lobifaro is a CPA that we do a lot with and have worked with a lot of mutual clients over the years. Domenick is an awesome resource for dentists. He is a principal at LLI Advisory Group, which is in Cranford, New Jersey. And for more than 15 years, he's provided tax, accounting, and business consulting services to high worth net individuals and closely held businesses, and with a high concentration in healthcare. And within that healthcare concentration, a whole lot of dentists. And uh, Domenick and his firm help dentists around the country, and we have a number of mutual clients that we're working on deals right now. So, format tonight, it's going to be a little different. We've done some PowerPoints in the past with Jake and Chris and myself, but tonight we're just going to do a panel discussion with Domenick, and we're going to talk about really financial due diligence, cash flow analysis, and projections, the things that are really important for anybody that's making any kind of business decision. Whether it's you're purchasing a practice, buying into a practice, or in the future, if you own a practice and you're going to bring on an associate, or you're thinking about dropping insurances. Like back in the old days, you would just kind of do things on a hunch. It's like the old school, like baseball, back managers even in the 70s, mid 80s, like, well, he's got a gut feeling that this guy's going to be, the right guy to bring up as a pinch hitter with the bases loaded and 2 outs, right? Now, no decisions get made at any level without kind of doing that quantitative analysis. And, I like to say, and some of you may have heard this from me, and if you have, you're going to hear it again, and you're going to hear it again and again. We as lawyers can really, obviously, a little biased. We feel like we have a very important role in a lot of these transactions. Again, buying practices, buying into practices, all that stuff. But we can do the absolute best legal job in the history of the world. But there's one thing that we can't do, which is we can't make a bad deal good. And the key is when you're looking to do anything in your business or entrepreneurial transitioning into ownership, you have to really identify what this deal looks like to you. That's how you have to assess it to see if it's good or not. And you can't make assumptions that just because you have a friend that did a similar deal that your outcome's going to be the same or the cash flow is going to be the same. Every single dental practice that we look at, and I'm sure Domenick too, they're all different. So you can't say this is not one size fits all. It's really important to work with somebody that is able to get under the hood, look at this practice, and advise you. And I like what Domenick does, and this is what I think really makes him special. He's able to advise you in a way that is understandable so that you can make an informed decision about the business aspects of a transaction. When there are people that come to us after the fact, because our clients, we always make sure they're working with good people with the cash flow analysis before they do a deal. But we have clients that come to us after the fact and they say, this deal's not as good as I thought it would be. And we'll talk and I'll ask them like, well, who did you work with to help you with the cash flow projections before you bought into this practice? Well, the broker gave me some numbers. Like that's not an acceptable answer. And so what you find out is that, if you do this and you skip this process, which is working with a really good financial consultant, and really we're talking about a CPA, then you're just taking what's behind door number two. And you don't want to find out 6 months or a year after you've done a transaction what it looks like to you financially. And, there's very few situations that we see after the fact that would have been different, couldn't have been different if you had done the analysis beforehand. So, with that as an introduction, again, welcome, Domenick. Thanks for being with us tonight.
Thank you for having me. I appreciate
So,
it.
as we talk about cash flow projections, due diligence, what tell the folks that are listening now, what does that mean to you, and what is your role in that process? And let's go from there.
Sure, sure. Um, yeah, so just real quick about my practice, just to elaborate a little bit what Rob was saying. So that 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 summary about us, I can't believe it's 22 years since we've been in
Okay.
practice, specializing in dental accounting and CPA services. And I've been practicing now for 34 years, even though I know I don't get, but 34 years as a CPA, time flies. So we love what we do. We handle probably close to 400 dental practices at this point. And as Rob said, we have clients throughout the country. So a lot of
Let me
what we
stop
do,
you for a second,
yeah,
Dominic, again. So we should also say this. So
yeah,
Dominic, you do help people with financial due diligence, cash flow analysis when they're buying
mhm,
practices, but you
yeah,
also obviously help dentists and dental practices that are practice owners with their
mhm,
taxes and consulting, throughout the year and over the years as well.
yeah. And that's really our primary business. So, as we, interact with attorneys such as yourself and the different bankers and the brokers, so we do as a natural extension of our accounting and tax services for dentists, we help them analyze purchases or in transitions, either selling or buying. So we represent a lot of buyers in this case. And when we do represent buyers, it is our job to inform the buyer to let them know, well, what is this practice really making? What is the cash flow of the practice? Is it a viable practice to purchase? And there's a lot of different components that go into that, right? So, as I was telling Rob earlier, it starts with the tax returns, right? The tax returns is what gets reported to the government. We ask for P&Ls and so forth. And oftentimes when you look at these numbers, they don't necessarily paint the picture as in terms of how the practice is really doing. Because if an accountant's doing a good job, the tax return usually shows a very small profit. So it's our job to get really behind the numbers, right? So we'll ask for production and collection reports. We'll ask for details of the financial information, such as general ledgers. Because we know the industry so well, we can look at a P&L and know right away pretty much what does industry standard tell you in terms of what the expenses should be. And then we'll compare that to the practice that we're looking to for the when we're representing a buy to purchase. So we'll make sure the dental supplies make sense. We'll make sure the payroll makes sense. And oftentimes a lot of these numbers are commingled. So oftentimes when the broker is good, they lay out the financial information first, so it's a little bit easier. But many times that's not the case. So we really have to carve out all the discretionary expenses. So if they're paying a family member, or if they're spending money in supplies that's really quote unquote personal in nature, right? So it's our job to carve out all these expenses to come up with the true operating profit of a dental practice. So that's the starting point. Once we know what the true operating profit is, then we could say, all right, when the buyer is buying this practice, they have to go out and get financing for the practice. So typically, banks will lend 100% of the purchase price typically. And with that, we'll amortize that loan usually over 10 years. The banks will lend up to 15 years. But in our opinion, a deal shouldn't work with 15-year financing. It should work at 10-year financing.
Hey,
15
Dominic,
years
just
yeah,
speak to that just for a second, if you could. Like,
sure,
what's that
sure.
distinction? Why does that matter to you? Why is that important?
That's important because in the definition of a good deal is you want to make sure that the person buying the practice is making a good income, right? Definition of a good deal is the clinician should be earning a salary as if they were working as an associate. So as an associate, let's say rule of thumb is around 35, 37% of collection, specialist around 40, 45%. They should be earning at least that because if they're working outside, that's what they would be getting paid. But of course, you want to make more than that. You want to be making more than what an associate's making because you want a business. You're spending money to buy this business. You're making an investment. So that
And
investment
risk too, right? I mean,
and a risk.
if you borrow $1 million,
Right.
you want to have some kind of
Yeah.
return on that risk,
So
right?
so you want to be rewarded for that investment and that risk. So after receiving a salary working in a practice, you need to make an additional profit on top of that. And that profit that you're making above and beyond the salary as an associate should comfortably pay back the bank over a 10-year period, not a 15-year period. Because if the numbers only work over a 15-year period, that means it's not a good deal, right? So the number should work at a 10-year amortization period over the life of the loan. Interest rates run around 5 to 6% right now. And then even after paying back the bank, there still should be some money left over, right? And that leftover money is for working capital, investment back into the business. There should be some element of profits above and beyond that. Now, if there isn't any leftover profit, then we have to evaluate, well, why is that? And well, that really comes from the fact that the practice is not very profitable, right? A very successful practice typically has a 45% profitability and 55% overhead, which is industry standard. Some practices have a little bit less, some practices have a little bit more. So in analyzing a practice, practices that have a higher profitability can typically command a higher price, right? So in my example where the practice doesn't cash flow very well, meaning that, okay, it covers the bank note, but there's really nothing left over, then perhaps we can negotiate a lower price so that the cash flow does work, if that's possible. Alternatively, sometimes a practice isn't profitable because it could be that it's mismanaged, right? So if it has strong collections, but the expenses are high, right? When a new owner steps in, if they're a savvy business person and they have a good advisor to point out the areas that are deficient, and they can turn those costs around. For example, in dental supplies, if their dental supplies are 10% of collections and they should be 5%, perhaps they can be a little bit more shrewd in purchasing, not being wasteful, controlling the purchasing, not over purchasing. So saving 5% on dental supplies, that could be a significant number. So, and that's
Let me
just one
jump in here for a
example.
second,
Yeah, of
if I could.
course. Yeah.
So, like, I feel like, this can sometimes be a risky thing when you talk about these underperforming practices. That
Hmm.
I feel like, what you just
Hmm.
gave is an example of, a practice that, may be underperforming, but there's like a path to fixing it. I think that that's an important thing for people to keep in mind, that this is not like HGTV where you go and you're like, hey, here's the house and we're going to put in a new kitchen and new bathrooms, and miraculously, like anybody that's ever done a home a home improvement project realizes how ridiculous those shows are, because it's like 3 weeks later they've done all those
Yeah.
things that are finished and the house looks great. Like that's not the way
Hmm.
the real world works. But like it doesn't necessarily go like that in dental practices. Like there needs
Right.
to be a good reason and a good strategy and something that can be changed. Like let me give you like the flip side. What I see sometimes, Dominic, and I get concerned is
Hmm.
people, if you have high staff, overhead, high salaries, high payroll,
Hmm.
like that's not, and from my perspective, that's not such an easy thing to fix. Even though
No,
you don't
correct.
have to pay those people, you can't pay $750,000 for a practice and come in and cut everybody's salary and benefits on day one, and expect that, they're going to like it and stay. So, if you can maybe speak to that, what
Hmm.
types of, quote unquote problems or issues are fixable, and what are maybe some red flags that people should really be more careful about if they're looking at a practice like that?
Yeah, good point. So in my example, dental supplies, that could most of the time be fixable, right? So that's just really a matter of, as I said, shopping your dental supplies, not being wasteful, understanding business, controlling the purchasing. Some of my clients or some buyers that I look at, they leave the ordering to a dental assistant or a hygienist and they don't monitor it. So, I'll point the things out and then I'll say to the buyer, it's up to you. We won't buy the practice on the potential of cutting these costs. We're going to assume that those costs are going to continue, right? It's up to the buyer then to trim those down. So if they could, then obviously it's a benefit to them. Now, as Rob was mentioning, certain expenses can't be fixed immediately. So payroll, for example. Now, what's an easy fix if the practice is overstaffed? So some dentists like to have two or three assistants. I have many clients that just have one. It depends on how you want to practice. So if you feel comfortable practicing with one assistant and there are three, that potentially is an easy fix. On the flip side, if you start cutting staff, it could reduce morale and make other people unhappy and uneasy, and may cause them to leave. So again, you have to be very cautious when it comes to payroll. In some instances, there's a staff gets inherited that's been with the practice for a very long time, which is actually a very good thing. But over time, they may have gotten significant raises, so everyone is maybe on the higher scale of what the salaries should be.
And
And again,
that's not an uncommon thing,
not a
right,
bad
Dominic? I
thing.
mean, I
Yeah.
think there's a lot of like older dentists that have been around, you're like, you get to the point where like, you know what? I'm just going to pay people because I don't feel like dealing with the aggravation of having to hire a new person, right? So,
Yes.
or people have worked there for 25 years and every year they get a raise and, all of a sudden, they're waking above market.
Yes. Exactly right. Exactly right. So what I typically tell buyers is when you're buying a practice, don't change anything in the beginning. Leave everything the way it is. Keep your employees happy, and then make changes slowly over time. Labs is another area. You have some practitioners that like to buy from a certain lab. They may want to buy from a high-end lab, right? Now, that's a clinical decision, right? What I'll advise a client is, maybe try a cheaper lab that still can give you the good quality or the high quality. But again, that's a clinical decision. So that's another example of that's something that could possibly be changed, not necessarily, right? Depending on the practice that's being purchased. Marketing budgets that could be adjusted, right? Some people pay a significant amount of money for marketing, right? From my perspective, what I tell clients is you need to track your marketing. You need to figure out, well, what is the return on investment from the marketing dollars that are being spent, right? Not everybody tracks that. And it's not something that's easy to be tracked. But when a patient comes in, you need to find out where they're coming from. Many dental practice management softwares allows you to run a report to give you revenue by marketing source so you can determine what the return on investment is. Some practices spend 30, 40, 50, $100,000 on marketing. And on the one hand, you may want to cut it, but if you cut it and it's feeding new patients, then obviously that's a detriment. So before going in and cutting it, you want to try to track if that marketing effort is being effective.
I feel like when it comes like marketing, from what I see, Dominic, you probably even see even more. That's like
Hmm.
so all over the map. Like you can't
It is.
just assume because you pay a lot for your marketing that you're getting good marketing, or you can't assume that
Right.
that cheap marketing is bad marketing. Like and
Hmm.
like the nature of the relationship, the
Hmm.
nature of the services, the quality. Like there's just no you sort of rhyme or reason to it sometimes. And I think
Yep.
that's a place that, as much as anything, you got to be careful about where you're spending your dollars. And I'll just say, it's sort of like get off the track a little bit. This is where I like to see, I don't like long-term commitments to marketing companies. I feel like if a marketing company says you got to sign a 1 or 2 year contract with us, like, that you can't
Right.
terminate if you're not having like that to me is like that's a bright yellow flag that,
Hmm.
you got to be careful because you just don't know. There's no sort of like given that they're going to deliver the value for what you're paying. So that's you
Absolutely.
see that ugly stories a lot in that front.
Yeah, and on the flip side, on the opposite end of that, I'm actually representing a seller right now, a client that's been with my firm for 20 years, and he's now looking to sell his practice, and he spends between 150 and $200,000 on marketing every single year. He does a lot of big case marketing.
Mhm.
There's a lot of big cases, full mouth restorations, a lot of implants, stuff like
Yeah,
that.
yeah.
So in his case, now that we're getting his P&L ready to put to market, we're going through his marketing efforts with a fine-tooth comb because what we're trying to do is in presenting the P&L to a prospective buyer, and this is what I always recommend when I'm representing a seller. A good CPA should prepare that P&L with all the add backs and not leave it up to the buyer's CPA to calculate the add backs to come up with a true profitability because the seller CPA is going to do a better job. So in my case, when I'm representing the seller, marketing came up and he spent a significant amount of money. So I said to my client, I said, listen, you spent $200,000 last year, right? And he goes, this marketing campaign that I've been spending $50,000 over the last 3 years that hasn't given me any results. I said, you know what? That's really should be an add back to profit. However, we have to prove to a potential buyer that that is not a required expense that should be maintained going forward. So, it works both ways, right? Um, So that's an example of something that could be potentially changed, but with care.
Let me say that here's one that's not. I feel like I just
Mhm.
have the negative ones. That's our
Yeah,
job here. I said
sure.
all the bad things that could happen,
Yep,
Rob, Jake, and
yep.
Chris.
Always got to
That's
worry
our
about the what ifs,
us.
right?
Yeah, yeah. Real estate costs,
Mhm.
leases, that kind of real estate related
Yeah.
overhead, triple net
Mhm.
expenses, real estate taxes, that kind of stuff. That's one
Yeah.
that can't put that genie back in the bottle easily.
Yeah, especially in New York City. I mean, the rents in New York City are astronomical. Typically we want to see rent to be about 5% of collections. In New York City, it's easily 10 to 15%. So that's some, overhead, fixed overhead obviously can't be changed. So that's a big one. Exactly right.
Let me just pick up on something else to kind of move on a little bit. We can come back to this, but I think I think it's important for people to realize this too. Like when clients will come to us, and a lot of our clients are first time legal consumers, they're first time, CPA consumers. They've never done these deals. So, I think that, a lot of times people don't realize kind of the importance of this process and how this all goes together. And they'll say like, they're asking $900,000 for this practice, but can you help me negotiate a lower price? Like, well, yeah, I can, but if it's just going to be me as the lawyer saying not 900, but 725. Okay, 725, Rob. Why? I don't know. It's less than
Right.
900, like my guy
Hmm.
told me,
Hmm.
because we want to pay less than asking price. Like that to me is not, compelling or a constructive way to negotiate. So when Domenick's talking about these things, to the ad backs and understanding where the profitability of the practice, what the overhead looks like, what the cash flow looks like, this is how you really, I think, make a compelling argument as to what the value of the practice should be. Because it's very different to say, I'm not going to pay you 900, but I'll pay you 75. Why? Because it's less. As opposed to, no, I'm going to pay you 750, and here's why. I'm going to look
Right.
at these things. These expenses are high. I can fix these. I can't fix those. This is what the cash flow looks like. If I borrow the money, pay this loan back over 10 years, at your price, I'm losing money. I'm not buying your practice to work in it to lose money. But if we can make it this number, then it does work for me. Like that is a much more compelling argument for a lower purchase price than just horse trading. And so this is really where, and we'll kind of get Domenick's impression on this too, but I just want to say, as Domenick's talking about finding the expenses that are inappropriate, or finding the sort of where the problems are and where the trouble lies, or where the money's kind of going. This is where it's really important, crucial to work with somebody who is dental focused, who's been looking at, you know, dental P&Ls for 22 plus years, right? And understanding, where these numbers are and what they should be, because you can go to a fine accountant who's never done a dental deal, and there's something that they can do, but they can't go this like extra bit to have that industry knowledge to know what to look for and what's normal. Same thing in our world. Jake and Chris and I, we look at contracts. A lot of lawyers can do what we do. This is employment law, real estate law, asset purchases, M&A. But understanding kind of what's normal and what's right and what's done and what works in the dental industry is where it's important to work with your dental focused CPA, dental focused lawyer, and other team members that understand this business.
Yeah, that's an excellent point. And in fact, Rob and I are working on a deal right now where we have a practice that's being sold, and the practice is being sold to an existing associate working in the practice. And the seller had come up with a valuation done by a dental supply company, and the valuation was very high. So I had redone the valuation, and I came up with the lower valuation. And in fact, I was able to justify my lower valuation because the cash flow wasn't there. And as a matter of fact, we even took the valuation to the seller's attorney, who happens to be dental specific, which is excellent, by the way. When you have two dental specific attorneys, they get it. They understand the finances of it, even though they don't do that, but they understand the economics of how a deal should work. And believe it or not, the seller's attorney agreed with my analysis. So, he did take it back to the seller who he was representing and said, listen, Dom knows what he's doing. This is why he thinks it's worth this. And now it's really up to you. Do you want to lower the price, or perhaps lose a deal? So yeah, you have to stand behind. You have to explain why you want to pay less because practices, good practices can command the premium. The market is definitely a seller's market out there if it's a good practice. But at the same time, if you have a savvy buyer with competent professionals behind them, they're going to let them know, well, what's a good deal and what's not, and what you should pay for this.
I feel like, when you talk about what's a good deal, I say this to clients often and initial
Mhm,
consultations with them, and they're looking at buying a practice or buying into the practice. I feel like the valuation just gets way too much airtime. Like it
mhm,
obviously the valuation, and especially in buy-ins, it's one thing if you're buying 100% of the
mhm,
practice, it's a more simplistic transaction. There's more transparency there. But especially when you're looking at buy-ins, and
mhm, mhm,
um, so beyond just that, the valuation obviously is what's going to say this is the number that you're going to borrow from a bank to pay, and that's part of this formula. But I see so frequently, again, especially in buy-ins, where if you value the assets of the practice the way you typically would, if you say, well, here's a valuation of the assets, like, and then that a lot of times gets paraded around in any type of transaction. This is what it's worth, whether it's a stock purchase, it's a buy-in, it's an asset purchase. You have the same, dental supply company prepared valuation that is, the number. And I feel like I'm not going to say that doesn't matter, but that is not at all what I want to know when I say, hey, client, let's get a good dental focused CPA involved here to do the cash flow analysis. Because I feel like you can have a practice that's quote unquote valued by the big dental supplier for $800,000 that you're paying 700 for, that you make 250 a year, or you could pay 900 for a practice that's valued at 800 and make 350 a year. So for me, I don't really care about
yeah,
the valuation. If you're still going there, you're owning this practice, you're doing dentistry every day, the valuation, but cash flow, that's what matters. And that's where when you start to look at, what Domenick's talking about, overhead and all these other factors and ABEX and these things, understanding what is a more profitable practice. Just because somebody, and none of these valuations are by any means scientific. I mean, and I laugh, especially, and they have to do it. The
mhm,
practice appraises for $797,500. Like, wow, that's really precise, right?
right, right,
And so you really that number is sort of like kind of a range. And I think a lot of times, and I think I've heard you say this, Domenick, somebody that's going to advise you on this when it comes to valuation is going to say, yeah, I think it's like 700 to 825, right? Because, you're not going to take it down to the penny. And then the magic really comes in. What does the cash flow? Let's do a projection of what the cash flow is going to look like when you borrow that money, but especially when you buy in, because there's so many factors. I'm going to talk about that in a minute, but there's so many factors in the buy-in. But I just feel like, yeah, the
right.
cash flow should be number one on the list. Valuation is somewhere farther along in terms of priority.
Yeah, and that's a good point. When I'm representing a buyer, and if a practice is grossing $1 million, on average, practices sell for about 75% of gross collections, roughly, right? So, the practice could be listed for $750,000, or it could be listed for $1 million, right? But if the profitability is 50 to 60%, I I could tell a buyer, yeah, 100% of collections, I would do that all day long. If it's going to make, 55, 60% of collections, I think it's well worth it, right?
Right.
And
Right.
conversely, and if a practice is selling for, 900,000 and the seller, the buyer offers 850 and they can't come to an agreement, I don't tell a client, well, it's only worth, you know, 850. What's the difference if you pay 900 over a 10, 15-year loan? Is that really going to change your life? Especially if you can walk into this practice make a couple of changes, and make
Hmm.
up for the difference. Our philosophy is, we don't want you to make a bad deal, right? But we don't want to kill the deal either, right?
Right.
We want you to, pursue it if it fits all the other boxes, right? Is it the location you want to practice in for the next 20 or 30 years? Does it have the amount of opportunities that you're going to be able to make a lot of money with? Is it fee for service? Does it have a lot of equipment that you're used to practicing with? Does it have the latest technology, and so forth? So there's a lot of other intangibles to warrant the practice, commanding a little bit of a higher price. So,
Yeah. Yeah. And I think, we can just talk about partnerships and buy-ins too, because I think
mhm.
this is the most critical type of transaction to have your arms around the cash flow because there's so many variables with that. Because now you're looking at what that partnership relationship is, and there's a lot of legal and practical things. If you're a younger dentist who's buying into a
And
50% interest.
big tax implications as well, potentially.
Absolutely, absolutely.
Yep.
If it's
Hmm.
not handled right, there's optimal ways to do that. But
Hmm.
like if you're an associate in the practice and you are doing one third of the production, and then you're going to buy 50% of the practice, that to me is always a warning. Like I'm always going to ask the accountant, let's look at that. Let's be careful about that because a lot of times my observation, Dominic, and tell me if you agree or disagree, most dental practice partnerships, the lion's share of the money that's being made is attributable to the clinical services that are being provided by the respective partners. So like the partnership split at the end of the day, for hygiene and whatever extra is on associates, that's a much smaller number usually than the number that is attributable to the actual work that you're doing. So if you are only doing a third of the work, but you're paying for half of the goodwill, that's when I'm starting. A lot of times I'll see those deals from a cash flow standpoint don't always work out. Like that to me is one of the as the accounting layperson here,
Hmm.
that's one that I'm like, we need to make sure that somebody's looking at that. What do you think about that?
Yeah, so that's a good point. So in your example, if the associate that wants to buy in is doing a third of the production, and let's presume there's another doctor in there, and maybe they're doing a little bit more than a third. Again, it comes down to, well, what is the cash flow? And that matters as well, right? So, what is the overall profitability? What are the hygiene collections? Because that plays into it, right?
Mm.
So if they're buying 50%, ideally you'd want them to both partners to participate as equally as possible, but it doesn't necessarily matter all that much depending on because usually what happens is and the right way to do it is each clinician that's practicing should get paid salary based on their production or collections, right? So they're getting paid for their efforts. Then the profits at the end after the salaries get split based on ownership percentage, right? So if they own it 50-50, the remaining profitability after each respective doctor gets their salary then gets shared equally. Now, some people have argued and say, well, if I'm doing two-thirds of the production and you're doing one third, why should we split the profits equally, even though we're still getting paid our respective salary? And there's two arguments to that. One is, well, I still own 50% of this particular business, and usually the profitability after the salary, if it's a GP practice, comes from the hygiene, right? So one argument is, well, I own 50% of the business. I should get 50% of the profits. On the flip side of that, the doctor that's producing more could say, well, the hygiene is coming from the fact that I see more patients. So those patients are my patients. So that's why the hygiene department's a little bit busier. And so there's more profits because of my patients. And there's some curative ways where we can adjust for that. And we'll put in some metrics, and one possibility would be, well, after a certain amount of production, then on those particular patients, instead of getting, let's say, 35% of collections, I'll get 37%, something to that effect. So there's ways to compensate the clinician that's a much bigger producer than the other one. again, typically speaking, especially if you're buying a practice, if you're paying, 50% of the value of a business, presumably you'd want to get 50% of the profits. That makes sense in my book.
Or even 50% of the ability to produce 50% of the clinical dentistry, right? I mean, that's the
Correct.
problem.
And that was your point exactly,
Yeah.
right? So if you have, the senior doctor, for example, who's hogging up all the procedures and not giving the junior doctor the ability, right? Or and if that's the case, yes, you want to share in the production equally, right? Sometimes a younger clinician doesn't have the speed yet to be able to produce half. And if that's the case, that's okay. But
Mhm.
it's not okay if the senior doctor is, hogging up all the cases, all the big cases, and leaving the lesser productive cases to the, junior partner. That's not fair.
Right. And,
That's not
and,
fair.
and, in reality too, like, and that might be a case for like, well, then let's not buy 50%. Let's buy
Yeah.
25% until you've kind of gotten
Yeah.
up there with him.
Hmm.
And because ultimately, with all dental transactions, we're talking about goodwill here, whether we're
Yeah.
talking about we're selling a practice or buying a practice and we're allocating the purchase price between hard assets, the equipment and goodwill. Goodwill's, 85-ish% in that. It's the same thing, even though we don't allocate usually the purchase
Sure.
price in a buy-in, you're still what you're buying into. The equipment's not worth bupkis, know,
Yeah. Not much. Right.
use dental equipment. So like even a buy-in, even though we don't do a line item allocation, you're still buying goodwill, and goodwill is, those, patient relationships and the ability to treat patients. And if the practice is set up in a way that you are going to pay for half of the goodwill, but you're only getting 25% of it in reality, then
Right.
that's something you have to look at from a cash flow standpoint and from a practical standpoint too.
Yeah. So in those cases, we'll run the cash flow based on, the doctor doing a third of the production or whatever, 25%, and then, sharing in 50% of the profits. We'll look at, well, what does that cash flow look like to the buyer? And, we want, again, we apply the same principles if you're buying a practice outright versus, buying into a practice. So cash flow is key.
Yeah. Okay. Um,
Yeah.
I know I'm kind of hogging the mic here. I know Chris had some
Yeah,
thoughts and questions that we were chatting about earlier for you, Dominic.
yeah, and I think
Sure.
you definitely covered on the couple points on normalization of the P&L and how important that is. So when you do your cash flow analysis, you
Mhm.
can't take the P&L that's presented to you from the seller side in those certain circumstances. You got to go through and do the normalization and the add backs. Um, just to get more of a true and accurate number. One question that I was thinking about is when you forecast out for patient volume, what types of data points do you look at for that when you try to give a new practice owner that information on this analysis with the forecast of patient volume to be expected? Is it like an average? Do you increase a certain amount? What kind of steps do you use for that?
So typically what I'll do is I'll look at the history of the practice. I'll look at 3 years production and collections to see the trajectory of how the practice has been doing over the last 3 years. And I'll talk to the buyer and I'll ask the buyer, well, what type of procedures do you do versus what the seller was doing before, right? So, and that's a very important question because, if you have a seller that's doing most of their own endo, right, and they're doing Invisalign and they're placing implants, let's say, then you have a buyer that comes in that doesn't do those procedures, that's a problem, right? They're not going to be able to maintain the same level of production. And quite the opposite. The opposite is also true where, a seller doesn't provide that many procedures where a buyer coming in does all of these extra procedures. And I have that situation now. I have a client that took a practice doing, five, 600,000 a year to $2 million, which is an extreme case, but it's true actually. Just because the practice does, the new practitioner does a lot more procedures. So that plays a role into, you know, projecting out what the practice could potentially make. I don't necessarily provide projected P&Ls. I'll kind of just do a brief analysis of what I think it would be, and a lot of it has to do with, past performance and how the practice has been progressing through the years. Sometimes you'll have a practice that's declining, and sometimes it's justified because maybe the seller, is practicing 3 days a week instead of 4 days a week, right? So, and then maybe the practice will go up to back to 4 days once the practice gets sold. So, we may add an additional element of that, but typically what we try to do is we try to put the buyer into the exact shoes of the seller and then see what the cash flow would look like. And I know, past performance is not indicative of future results, of course, right? But that's all we can go on. So I don't necessarily like to speculate on what a future projected P&L is going to look like. Try
Yeah,
not
let me
to do
just jump in here. It's funny you say that because it's been a while since I've seen this, but because I
that.
think I think buyers have become more sophisticated and sellers too. I think that just generally the dental transition business is a lot kind of tighter than it was. I will tell you in the mid 90s, which was,
Hmm.
it was crazy back then. You just had people doing valuations that had no, business doing that, and people's qualifications and the quality of that, the loans, everything was kind of, yeah, a little sketchy, but so it's become, it's really upgraded a lot. But, so I don't see it as much, but I still do see it from time to time, which is where you see, non-CPAs or brokers doing projections to
Hmm.
support
Hmm.
these purchase prices, that they'll just assume this like crazy annual growth. Well, if the practice grows 10% a year for the next 8 years, this is how much you're going to do. So this is a great,
Yeah.
great purchase price, and
Hmm.
and so
Hmm.
obviously, Domenick, you as a CPA, you wouldn't do
We don't
that,
do that. No
right?
way.
You
Nope.
can't do it because
Right.
you've got those CPA rules to
Yeah.
play by. That if you're looking at a evaluation that's prepared by somebody that's not a CPA, there are no rules, and it's kind of the Wild West. So, but it's been a while since I've actually seen a bad example of that, but I used to
Hmm.
see it a
Hmm.
lot, which is back in the day when I was always very much a proponent of, you got to get a CPA looking at this. You got to get a CPA looking at this before I got on the cash flow soapbox. But yeah, it's being
Interesting.
aggressive with projections is
Right.
something that you
Right.
got to be careful about.
Absolutely. Sure.
So, Jake, I don't want you to feel left out. So let's throw out a softball here. Let's talk about sort of, Jake, and for people who joined a little late, really heads up the real estate transactions in our firm, helps people with their lease reviews and negotiations. Yeah, just as startups and standalones, but then Jake, a lot of times will support in deals on the real estate aspect of things. So, in the real estate world, Domenick, we see a lot of times people are really bent on, I want to own the real estate, or I don't want to buy the real estate when I buy the practice. I just want to do a lease. I feel like I find myself very frequently having conversations with these people about whether or not it's good just to be that sort of committed to one position or another. I mean, first off, and just step back, a lot of times lenders will lend 100% to purchase of the real estate purchase price if you're buying it with a practice, which is an opportunity that you should really, I think, always consider. But I always find that, this is like one of those, this is an easier cash flow. This is a cash flow that I can almost figure out, right?
Hmm.
Which is, you don't want to buy it, or you don't want to buy it. You want to lease it, and oftentimes, I should say often, rarely are those people making those decisions based on the cash flow. The difference between owning and leasing, and is one cheaper than the other, and frankly, and I just kind of take another step, and then I'm going to turn this over to you, kind of get your thoughts, Domenick, and you too, Jake. But I feel like people have like sort of this false sense that if you own the building, that, it's somehow like all these expenses go right into your pocket, like you're paying yourself all the time. You still have a mortgage you have to pay, so sometimes
Hmm.
that's not great. You don't have the ability to get tenant improvement allowance if you're doing a startup, for example, and leasing. But so it's not always, what it seems it is. But I feel like this is another somewhat obvious cash flow moment that you should make these types of decisions. Are you going to own or rent based on the respective cash flows of both of those options?
Yeah. So, when we're looking at a deal, if the real estate is for sale, and the bank is willing to finance the purchase of the real estate, we'll look at the cash flow, right? And, typically the real estate can go out a little bit longer, 15 years or so for the financing of it. Um, But what people don't consider sometimes is, you have to look at the condition of the property, right? So when we're doing a cash flow, if the cash flow is fine and the practice pays enough rent to cover all the costs of carrying the building, that's great. But how old is the building? Is it 30 years old? Does it need a new roof? Does it need a new boiler? There's all these ancillary costs that can hit you down the line, that you won't necessarily have to incur, if you're renting, right? Versus if you're buying. So, that's one thing you have to kind of talk through. But I am, for the most part, a proponent of buying the real estate because, again, you are building equity. It's another asset class under your belt. And it just, it enables you to have that extra asset upon retirement that, could help you, fund your retirement, 30 years down.
Yeah, it's not uncommon for people to go to a closing and I see that the real estate is sold for more than the practice, right?
Oh yeah. Oh yeah. Seen that. Sure. Sure.
Um, and I think too that it's interesting when you kind of see people have the mentality of I'm gonna borrow $900,000 to buy this practice and I'm gonna pay it off over on a 10-year loan. But I don't want to buy the real estate because I don't know if I want that kind of commitment. It's like, well, wait a second,
Mhm.
you've already committed and then some. Like you
Yeah.
don't think that, you're going to borrow all this money to buy this practice and like,
Mhm.
you're going to be able to give it back or, like somehow you're going to be able
Mhm.
to get out of the lease or whatever. Like
Mhm.
that,
Mhm.
you're already in, and so, and frankly, it
Yep.
couldn't be any more in. So, that to me, I think shouldn't really usually be kind of a factor as to whether or not you should own the real estate.
Yeah, listen, I think one of the major reasons you would want to buy the real estate is because you can control your own destiny, right? And I have a great example for you. So I have a client who, not a client anymore, he's retired at this point, but 10 years ago, I would go see him to go over his numbers, and he's like, you know what? In 5 years, my lease is going to be up, and my landlord already told me that I have to leave because they're going to take over the entire building. So at that point, he was going to be 55 years old. Now,
Mm.
at 55, you're nearing the end of your career, but you still got a lot of gas left in the tank, right?
Yeah,
So,
go easy on the guys in their 50s here.
yeah,
Yeah,
exactly.
right.
So, we would have these conversations, every single year leading up to, that fifth and final year when he had to make a decision. And at 55 years old, like, what do you do, right? If you want to sell your practice, you can't sell it for more than 50 cents on the dollar because you don't have a facility. You could only sell the charts at that point. Or do you go out and find a new space and spend six, seven, $800,000 to build out a new dental space, right? So in his case, what happened was he opted to build a new space. He didn't really have to, but in his case, he did because he had a daughter in dental school.
Yeah.
And he was hoping that once she graduated, she would work with him and then she would take over the practice. Turns out that after she graduated, she said she didn't want to practice at that point. So, but again, I like buying the real estate. You can control your destiny. You don't have to worry about anyone kicking you out. You know, mid-year, after your, usually it's 5 years with a 5-year option in many cases. I know Jake can attest to what he typically sees out there. But what happens after 10 years, right? Or even 15 years? What do you do at that point? You still have 10 years left to practice or so, 15 years left to practice. What do you do? You got to go out and build a new space or maybe get lucky and find someone that's, selling their practice and merging in. So it creates a lot more complexies, if
If
you're just
you're,
renting.
yeah, and on top of that, if you're leasing, then and you want to sell your practice, you have to get consent from that landlord to assign the lease as part of that sale, and that's not that consent's not always easily received. So if you own the real
Yeah.
estate, obviously you don't have to deal with that process at all.
Yeah. The number one deal killer, right?
Hmm.
Uncooperative landlord. Well, let's say that too, that though, if you do find yourself in that situation though, where you do lease, and you have a 5-year lease with a 5-year renewal term, when it comes time to renew that lease, you should always try to get an additional renewal term. So you've got additional renewal terms in the bank, so to speak. You don't need to exercise them, but you never want to get into a situation where if you can avoid it, you're down to the last couple of years and the landlord can move you out, and I think a lot of that, again, sometimes the landlord won't agree to it, but always try at renewal terms. You want to try to renegotiate as far as the economics of that lease and then what remaining term and renewal terms you have, because you've got leverage at that point. And if you kind of let it kind of go and run out, you may find yourself in a bad place.
And the banks are going to typically that are going to finance you are going to want to see those options as well
Right, right. So yeah, like Jake's
to build out the term to match the loan.
right. So if you're going to get a 10-year loan, which is common as Don was talking about, you are going to need a 5-year lease term with a 5-year renewal term or a 10-year term with renewal term. So they want to know that you've got the ability to be in that space for the term of that loan, because nobody wants to lend lots of money for you to be office homeless, right? That's you become a bad borrower, a risky borrower in that situation. Well, this has been awesome, Dominic. I really appreciate you taking the time. It's always love chatting with you and
Yeah,
geeking
it's my
out on
pleasure. It's just fun.
the financial aspects of this stuff. Folks in the audience here,
Mhm.
does anybody open this up for questions to Dominic? Any questions about anything we talked about, or just anything, dental, finance, tax, business? This is your expert here. Pick his brain. Okay. All right. So if we have no questions, we'll wrap it up. Dominic, if people want to get in touch with you, learn more about the firm and learn more about what you do, what's the best and easiest way for them to do that?
Yeah, so I can provide my contact information, or you can visit our website at www.llicpa.com, or my direct line, 908-358-0502. That's my direct office line, or my cell. I'm happy to receive text messages, 917-721-4913.
You're a brave man, Dominic, giving that out.
Yeah, and I don't mind. I don't mind at all.
And of course, anybody ever wants to get in touch with Dominic, you could always reach out to us, and happy to forward his information along or reintroduce you. Great resource. We love working with him. Does awesome work for our clients. Like I said, we can't make a bad deal good, so you got to know what you're getting yourself into. And Dominic is a great CPA experience that can help navigate practice transitions and really any business decision that you have to make, and quantifying that so that you can make an informed decision about that with the right financial information is just crucial. So thanks again, Dominic. It's always a pleasure.
Thank you so much. I appreciate you having me.